Do you know what pooled investment vehicles are? If you're like most people, you're probably scratching your head right now, even thinking, is it some kind of a new carpool lane or maybe an Uber? Well, don't worry about it, because I'm here to explain to you in the most simple terms what pooled investment vehicles are, using some analogy as well, that even your grandparents or your grandkids or anyone that you know who doesn't understand investing will understand. Imagine you and your friends, right, are at a restaurant and you all want to order different dishes but only have a limited budget. So what do? You can pool your money together and order a bunch of dishes to share. That way you get to try a variety of dishes without emptying your wallet. Hey, I've done it before when I was in Nando's. I've done it when I was in a Chinese restaurant, a Greek restaurant, any fancy restaurant I've been to, I've done it. And it is fantastic because I get to save money. A pooled investment vehicle works the same way. There's a bunch of people pulling their money together to invest in a bunch of different assets. It's like investing in a big buffet of stocks, bonds, and other investments. Now, you might be thinking, why would a bunch of people want to invest together? Why would I even want to invest with a bunch of strangers? Well, that is a very good question. You see, when you invest on your own, you are limited to the amount of money that you have to invest, knowledge, and expertise. Sometimes you might not even have the time to invest in each individual stocks. But with pooled investment vehicle, you don't have to struggle. You can get the benefit of getting leverage with the knowledge and expertise of professionals who will manage the fund for you. Plus, investing in pooled investment vehicles is a lot less stressful than investing on your own. You don't have to spend so much time just worrying about picking the right stocks or monitoring the market every single day. The professionals will take care of it for you. And here's actually the best part. Here's the best part that attracts people to pooled investment vehicles, because it is cheaper than buying individual shares in multiple different companies. As an example, you can invest in Apple, Microsoft, Alphabet, and many more other companies for as little as £100 in an index fund. Whilst with £100, you wouldn't be able to invest in all of these companies individually. That's because the fund manager buys large quantities of shares to create a portfolio, which reduces the cost for each investor. First off, we've got real estate investment trust, REITs. REITs invest in a bunch of different properties like office buildings, shopping centers, and apartments. You don't have to be a landlord to get in the real estate game. Just invest in REITs and let them do all the hard work for you, which means that you don't have to be worrying about tenants complaining just about things breaking. Who doesn't love that as a landlord? Next on the list is unit investment trust. These are like preset investment portfolios that hold a bunch of different stocks or bonds until the termination date. It's like a gourmet meal. Everything is curated perfectly and ready to go. At the termination date, you will receive the units at the stock market ongoing price. Third, we have exchange traded funds. These are like mutual funds on steroids. They hold a diversified portfolio of assets but trade like a stock on an exchange. The fourth on the list is unit trust. These hold a fixed portfolio of securities. However, unit trusts are actively managed, which means that the portfolio can change at any time. Think of it like a living, breathing investment strategy that adapts to the ever-changing market. Last but not least, we have mutual funds. Now, these are like the OGs of investment vehicles. They've been around forever and they're still going strong. Mutual funds pull money from a bunch of investors and invest in a diversified portfolio of assets. You see, the S&P 500 is a type of passively managed mutual fund that has been created by a fund company like Vanguard to mimic and benchmark the performance of the S&P 500 stock market index, which are the top 500 companies listed on the stock exchange in the United States. So an active fund manager is basically the boss or the captain of an active fund, El Capitano. These guys or girls are experts in the field of investing, and they use their knowledge, experience, and skills to pick out individual stocks that can outperform their benchmark. Now, if you want to invest in active funds, be prepared to pay a lot of money. These fund managers can charge some pretty hefty fees to their investors for their services. And when managers basically talk about, beating the market, they're usually referring to their benchmark. Think of it like a competition with other market players involved. But here's the thing. More than 80% of active fund managers don't actually beat their benchmark. Despite all their knowledge, experience, and skills, they still can't manage to outperform the market on a consistent basis. This is because of the pricey ongoing maintenance fees they charge on their performance. According to Spiva, which is a world's leading resource for benchmarks and investable indices, between 80 to 90% of actively managed funds across the world underperformed their benchmark for over 10 years. Think about it, it's crazy. Also, SCM Direct's research paper found that on average, 36% of actively managed funds simply clone an index. So while there are basically a few rare unicorns out there who can actually elevate their performance for over 5 years, the reality is that most active fund managers are just like the rest of us mere mortals. On the other hand, a passive manager's goal is to mimic a particular market index and keep the difference between any returns of that index and the fund's holding as small as possible. This means that a passive manager will not try to beat the market as a drawback, but rather match the performance. One advantage though of passive management is that it tends to be less expensive. Since passive managers do not actually need to do a lot of research and monitoring as active managers, they charge much lower management fees. To give you an example, let's just say that you want to invest in the FTSE 100, which is an index of 100 largest companies in the London Stock Exchange. A passive fund manager would simply buy shares in those 100 companies in the same proportion as the FTSE 100 index. This way, the fund's performance would closely match the index. And this is how it works. There are two classes of funds you can invest in: income fund and accumulation fund. An income fund pays out dividends directly to your fund account as cash on a certain date. Like stocks, you can choose to either reinvest the dividends back into the fund or have it sent to your bank account as an income. This type of fund is ideal for people who want to receive regular income from their investments to fulfill their short-term goals, like traveling, perhaps even buying a new car or paying off a loan. It's also suitable for those who have retired and actually want to have a steady income. An accumulation fund, on the other hand, automatically reinvests your interest, dividends, and income back without having to manually do it. This type of fund aims to promote faster growth through compound interest, which means that you earn interest on the interest earned. This is how compounding works for growth. It's a smart way to grow your portfolio with long-term goals like maybe retiring early, buying a home, or funding your child's tuition fees, which not many people are looking forward to if you're a parent. When it comes to funds, there are two types of pricing: single and dual pricing. Let's compare single price fund to a box of chocolate. Now hear me out here. Just like how the price of chocolate depends on the quality and ingredients, the same thing goes with single price. It depends on its underlying investments. Fund managers use something called the net asset value, which is NAV, to set the prices. Now, you're probably wondering, what is that? Don't get confused. It's just a fancy term for the total value of all the assets in the fund divided by the number of shares that are available. For example, if a fund has securities and cash worth 40 million with a liability or liabilities of 30 million and there are only 5 million shares available, the net asset value will be £6 per share. It's like knowing the price of your favorite box of chocolate. It's right there in front of you. So when you buy these shares in a single price fund, you know exactly what you are actually paying for. Buying a box of assorted chocolates. Hear me out here, I'm coming with something here, analogy. Okay, you get to pick the chocolates that you want and the price is based on its popularity and availability, demand and supply. When you invest in a unit trust or an exchange traded funds, you will see two prices, which is the bid selling and also the offer buying price of that fund. This is because they are traded directly at the stock exchange. The fund manager sets the creation price based on the cost of creating new units or shares and the value of the underlying assets, as well as dealing fees, commissions, tax, stamp duty, reserve taxes, anything that's to do with fees. Then they add the initial charge to the creation price to calculate the bid price. This fee compensates existing investors for any reduction in the fund's value caused by the cost of the underlying fund transactions when new units are actually purchased. Let's just say that the creation price, as an example, is £5 per share and the initial charge is about 0.5%. That means that the bid price will be about £5.025 pence, and the offer price will be £5 per share. And if you want to buy the shares, you have to pay a higher price, which is the bid price. And if you want to sell shares, you have to receive a lower offer price. So think of dual price funds as like a box of assorted chocolates. You can pick which ones you want, but the price might be different depending on the popularity, which is the demand, and also the availability, which is the supply. In the UK, fund suppliers set mutual fund prices every working day, either the valuation point or the dealing point. The valuation point usually occurs at midday, and you can find specific details about it in the fund's prospectus. For example, if you purchased shares at 9 a.m., you would receive the same day's forward price at noon during the valuation point. After the valuation point, the fund price will be confirmed on the investment platform. However, if you actually miss the valuation point and invest later, say for example 5 p.m., the fund manager will allocate your purchase to the next working day's valuation point. Okay, let's start off with open-ended funds such as mutual funds. These funds allow investors to issue and redeem shares on demand. Imagine an open box where you can buy and sell shares at any time. There is no limit to the creation of new units from an open-ended investment fund. When an investor wants to purchase shares or units in a mutual fund, the fund issues new units for the money that the investor deposits. When the investor wants to withdraw the money or withdraw money from that mutual fund, the fund redeems the investor's shares. Exchange-traded funds, ETFs, are also an open-ended investment fund, but trade directly at the stock exchange. They have two prices that I stated earlier on, bid and offer, which represents the highest price that the buyer is willing to pay and the lowest price the seller is actually willing to take for the investments respectively. Now let's move on to closed-ended funds such as investment trusts. These have fixed number of shares they issue, unlike open-ended funds, so it's more of a closed box. Fund companies cannot issue new shares unless there's a secondary offering or share repurchase, which is really rare. It doesn't always happen. Closed-ended funds sell their shares during the initial public offerings to raise money to purchase securities and other assets with the proceeds. Investors who wish to basically invest in the fund after the IPO will use the exchange. With closed-ended funds, the secondary market actually determines the price that an investor can buy or redeem those assets. If the market values the fund at a price higher than the fund's net asset value, it trades at a premium, which means that it is really expensive. So just bear that in mind when you're buying things and it says premium. If the market values the fund lower than the net asset value, it trades at a discount, which is obvious, which is cheap. You find that most investment trusts trading at the exchange are volatile or risky and illiquid because of the number of participants invested. Illiquid simply means you cannot easily convert your holdings into cash. If there are more buyers than there are sellers, you can find more people to basically trade your money, trade your investment for cash, making it more liquid. However, you find that most investment trusts trading at the exchange are volatile and illiquid because of the number of invested participants. If there are more buyers and sellers, you'll find someone to trade your assets for cash, making it more liquid. Oh, and one thing that I forgot is the prospectus. A prospectus is like a fancy brochure that companies and funds give to potential investors. It's a cheat sheet that tells you everything that you need to be aware of about the company, its opportunity, whether it's worth even deciding to invest in. Now, the brochure is actually no joke. It's simply no joke. It's packed with all sorts of information about the fund or the company. You find out about their management team, their business strategy, and the securities being offered. They'll also tell you about the risks involved in the company or the fund, about there could be potential legal implications or anything that is ahead that they need to let investors be aware of. But actually, that's not all. You also get a full rundown of the fees and expenses that you have to cough up if you decide to invest. And on top of it all, there are also a bunch of financial information about the company or the fund, like the account statements, income and expenses, and the performance history. So before you invest, take some time to read the prospectus carefully. Seriously, take some time to read it. It may not be the most exciting read. It may not be, I'm not going to promise you that. It's like reading an instruction before assembling an Argos furniture. You have to do it, or if you don't do it, you will not avoid disaster. You don't do it. It's that simple. Have you ever assembled an Argos furniture before? It is really bad. I had to use glue, hammers. I might as well build the damn thing myself. That is it. The next time someone asks you what pooled investment vehicles are, you can confidently explain it now. And if they still do not understand it, they don't get it, just tell them that it's like ordering a bunch of dishes at a restaurant with your friends. Who doesn't love that analogy? You get to save money, you get to have a variety of dishes, and there's less risk of actual losing money. Okay, that's it.